I buy ETFs in India and Australia while you're stuck with S&P 500. Introduction. Many say, buy the S&P 500 ETF and you will be safe. Sure, that works, but I want more. Faster growth, real diversification, less dependence on one market. In my portfolio, I hold ETFs targeting India, Australia, Eastern Europe, and Canada. Yes, there are risks, but missing out on potential profits can be worse. What is a country ETF and why people fear it? A country ETF invests in companies from one specific country or region, not the whole world mixed together. People worry about currency, collapse, unstable governments, inflation. Those risks exist everywhere. With a smart approach, this isn't gambling, it's opportunity. Why I invest in country ETFs? First of all, higher growth potential. Emerging economies often grow faster than mature ones. Young population, rising consumption, wages going up. Second, diversification. Relying only on the S&P 500 means being tied to the same economy, currency, regulation. Adding Australia, Canada, Eastern Europe introduces different growth drivers. Third, catching undervalued markets. When a country is unfashionable, its prices drop. That's a chance to buy in early, before others recognize the value. Fourth, less dependence on the US. The United States plays a major global role, but parts of my portfolio follow different cycles. Australian commodities, Australian stocks, Eastern European industry stocks. That balance matters. Here's currency upside. Investing in assets priced in a foreign currency gives you a second lever. If that currency strengthens, you benefit double from the business performance and the FX move. How I select country ETFs? 7 rules. Liquidity and fund size, low expense ratio, balanced index composition, currency risks and hedging options, political and legal stability, long-term track record, tax structure and sustainability, suitability for non-residents, risk and how I migrate them. Risks are real. Political instability, currency swings, thin markets. Here are safeguards. Limit country ETFs to 5 to 15% of total portfolio. Only select countries with basic institutional stability. Keep exposure in while at currency ETFs modest. Rebalance regularly. Take profits when a position grows too large. Examples from my portfolio. India. Bet on demographics and growing internal demand. Eastern Europe. Poland, Czechia, maybe Ukraine in the future. Often undervalued, linked to Euro-Union markets. Canada, stable, resource-rich, good mix. Australia, resource exports, stable institutions, exposure to Asia. Each ETF in my portfolio passed my selection criteria. This isn't guesswork, it's strategy. Conclusion and call to action. Country ETFs are not just risky, they are tools for growth and real diversification. With clear filters, you can avoid mediocre funds and find a real opportunity. These ETFs aren't the core, but they can turbo boost growth. Your move. Look at your portfolio. Do you hold any ETFs outside the United States? Which countries are you invested in? Share in the comments.